Okay, so this is question 8, past paper 2015. So this is for efficient market hypothesis, the big question, which will come in part B. So we are trying to answer what has been said before. So it says here, in the context of EMH, explain clearly the following terms. So weak form efficiency, semi-strong form efficiency, strong form efficiency. So here we will just highlight what we have spoken about and go into detail. So we need to deeply understand what these three levels of market efficiency mean. So you'd pick them one by one and explain into detail what they mean, as we have done in the previous video. So that will give you 4 marks each, giving you 12 marks. Easy. Now B, why is it important for the market to be informationally efficient? Now the answer we have, which we deduced from exam feedback from last year, is that the market needs to be informationally inefficient to ensure a fair game and investment for everyone on the market. So that's the exact answer for that part. If you do it, you've got your 3 marks. Now we move on to the more tricky part, which is, for each of the following information, briefly discuss the implications on market efficiency. This is what we were highlighting in the explanation of the 3 forms of efficiency. So you'd see where I write implications on market. So here, what we have to do with these questions is to relate each scenario to the form of efficiency it relates to, and we state whether it is consistent or it violates the theory. So the first one, suppose you know someone who devised and implemented a trading rule based on publicly available information. He showed you his returns, which are much higher than that would have obtainable by investing in board market index. So here, based on reading this, our answer would be that it violates strong form of efficiency because even insiders are unable to make abnormal profits. And if you look at the question, it says his returns are much higher than what would have been made if invested in board market index. So basically, we are going against the rule of the strong form efficiency because it says no one, even insiders, can make abnormal profits. Secondly, the Security and Exchange Commission has just released a report that there is not sufficient evidence to indicate any form of insider trading. Now, from what we learned before, the strong form of efficiency is, its main focus is insider trading. So our answer would be, this violates the strong form of efficiency because the focus is on insider trading in the strong form, but here, based on the report, there is no evidence of that. So that's how we would answer that question. Now the third one is, share prices tend to be higher on a Friday than on the following Monday. We discussed this in the weak form of efficiency. So our answer would be, it is consistent with the weak form of efficiency. And if you remember, we said share prices are higher on a Friday because people start to see the returns on their investments, and compared to a Monday where everyone is starting afresh and there's no market predictions on the share prices. Number 4, the top 10 investment funds in the US. Notice I've cancelled UK because a market can't outperform itself. So we think it's a typo. So in the US, outperformed the UK market by an average of 5% in 2009. We chose to go with semi-strong form because if you look at the empirical evidence of semi-strong form, it says anything related to UK and US stock markets is semi-strong efficient. Lastly, Royal Petrol PLC has just reported that it discovered a new method to turn domestic wastage into petrol. Its share price rises by 5%. So we say it's consistent with semi-strong form efficiency because new information is quickly incorporated in stock prices. So as a result of them discovering this new method of transforming domestic wastage, as a result, the share prices rise by 5%. Now we looked at one more question from the seminar, which is not in the exam paper but might be relevant, and it says a corporate's quarterly earnings report is just released. The company's profit meets the top end of the analyst's forecast, but the share price of the company falls by 20%. It was a little tricky, but we've come up with an answer and we hope to confirm it with our seminar tutor. So we say it's consistent with weak form efficiency because past information cannot be used to predict future results. So basically what it's saying is the analysts, we have produced a report for the first 4 months of the year, and that's based on past figures. However, on releasing the report, the share price falls by 20%. So that is indicative of what's going on currently with the company and not based on what the analysts forecasted or what happened 4 months ago. The end.